Gold does not explode out of nowhere. That is the lie people tell themselves after the move is over. They tell themselves gold is emotional, chaotic, old-fashioned, difficult to value, maybe a little paranoid, maybe something that only matters when the world is ending. Then, after it is already repriced violently, they invent reasons in hindsight and pretend the pattern was obvious. It was obvious, just not to the people looking in the wrong place. Gold does not begin its great moves with excitement. It begins with arithmetic failure. That is the mother line. Whenever governments get themselves so deep into debt that honest repayment becomes politically impossible. The sequence starts. First, the debt becomes too large to solve cleanly. Then the rules begin to change. Then cash becomes a trap even when it looks responsible. And finally, the people closest to the printing press begin exchanging paper for the one thing they cannot manufacture. That is the sequence. And every major gold explosion of the last century has walked through that same sequence step by step. Not approximately, not loosely. The same structure every single time. People think the trigger is fear. It is not. The trigger is debt math. That is where the whole thing begins. Once a government reaches the point where its liabilities are no longer realistically payable through growth, productivity, discipline, and taxation, the menu shrinks fast. In theory, there are two honest options. You can default, or you can make the money worth less. The first world political class hates the first option because default is obvious, humiliating, and immediate. It creates headlines, it creates blame, it leaves fingerprints, so they almost always choose the second. They debase, they never call it that. Of course, they call it flexibility, stabilization, liquidity, emergency support, modernization, targeted policy, financial innovation, temporary accommodation, or some other phrase designed by people who get paid very well to avoid speaking normal English. But the mechanism is always the same. They make the currency buy less. That is the first signal. The debt has moved beyond repayment and into management. Once that happens, gold begins getting interesting whether the public realizes it or not. Let's put it's not a promise to pay later. It is not someone else's liability. It does not depend on a central bank balance sheet of a politician's polling numbers or a Treasury Secretary's sincerity. It simply sits outside the game, and whenever the game begins relying on devaluation to survive, the thing outside the game starts getting re-rated. Now, let me show you how the second signal always follows. Once the debt problem becomes too ugly to solve, honestly, governments start changing the rules, always. That is the part the public never believes until after it happened, because modern people have been taught that the financial system is a neutral background. It is not. It is political architecture. It can be altered, it can be bent, it can be redefined, it can be weaponized, and when states get cornered, they do exactly that. In the 1930s, the United States did not simply talk about stability. It confiscated private gold ownership and then revalued gold upward. Think about the audacity of that. First they took the real money, then they changed the price of the real money they had just taken. The public did not wake up in a free market and discover a new gold price through some elegant process of price discovery. The state grabbed the wheel and rewrote the relationship between citizens. Gold and the dollar in one stroke. That was not some minor technical adjustment. It was an admission that the rules were never sacred. Fast forward a few decades. In 1971, the United States could no longer maintain the gold link, honestly. So the government did what governments do when promises become embarrassing. It declared the old promise temporary and then suspended it. Temporarily, of course, that temporary suspension has now lasted more than half a century. The dollar was cut loose from gold because the state needed room to keep spending, borrowing, and improvising. The public was told it was a policy move. In reality, it was a confession. Then came the 2008 era. The official language had evolved by then, so instead of calling it currency debasement, they invented prettier phrases: quantitative easing, emergency liquidity, asset purchases. The words changed because modern people have softer ears, but the substance was no different. They created trillions, backstopped broken paper, and rewrote the system again to preserve the debt structure and the institutions inside it. That is the second signal. When debt math breaks, rules get rewritten. Now look at the present. The debt is sprinting toward a level nobody serious believes will ever be repaid in honest money. And at the same time, instead of shrinking the system back toward discipline, they are building new channels to manufacture demand for the very debt that should have been rejected. Stablecoin regulation, government funding architecture, monetary gymnastics, rate cuts in an inflationary backdrop, all of it points in the same direction. The system is not healing. It is being re-engineered to tolerate more debt for longer. That is a rule change, maybe not one dramatic Sunday speech, maybe not one signature on one neat piece of paper. But across multiple policy channels, the old deal is being altered again. And every time that happens, gold notices before the public does. Now comes the third signal. Cash starts becoming a polite way to lose money. This is where ordinary people finally begin to feel the system turning against them, though most still cannot explain it clearly. They do what they were told to do all their lives: work hard, save, keep some money in the bank, collect a bit of interest, be responsible, be prudent, be boring. The balance even goes up. Everything looks civilized, and yet they are getting poorer. That is the signal. Not because the bank failed to count properly, but because the denominator has been corrupted. If your savings account yields 2% or 3% or even 4%, while the real cost of living is moving at 6%, 8%, or 10%, depending on how you actually live, you are not preserving wealth. You are reporting a smaller loss than you would have without the bank account. That is not the same thing. People hate hearing that because it insults the moral dignity of caution. They think prudence should be rewarded. In a sound money world, it often is. In a debt management regime, prudence held in currency becomes tribute. You are effectively paying the system for the privilege of standing still while it debases the measuring stick. That is why I say cash becomes a trap. Not because it looks dangerous, because it looks sensible, and sensible-looking traps are the hardest ones to escape. The 1970s made this brutally clear. Savings accounts and bonds yielded less than inflation for long stretches. People who thought they were doing the right thing discovered that the real value of their caution was being siphoned away year after year. After 2008, rates were pushed effectively to zero while real costs kept moving. People were told the policy was necessary. Fine, perhaps it was. But necessity for the system does not mean kindness to the saver. The saver still got punished. The pattern is identical. Now rates are being cut while inflation pressure still lingers. The message is once again simple. Holding paper is to be discouraged, because the state needs breathing room more than the saver needs purchasing power. It will never say that directly, but policy does not need to confess when it is already operating, and once savers feel that their money is melting even while the statement balance rises, they begin looking for alternatives. That is when the fourth signal becomes decisive. The people who issue the currency begin buying gold themselves. This is the part that should make every ordinary person stop in their tracks and think very hard. Central banks can create money, they can buy bonds, they can support banks, they can manipulate rates, they can engineer regulations, they can rescue markets, they sit closer to the source of monetary power than anyone else on earth. And what are they doing? They are buying gold. Why? Because even the printers know the limits of paper. That is the final vote of no confidence. Before the formal end of Bretton Woods, foreign governments and central banks were already rushing to convert dollars into gold. They could see what was happening before the public could. In the aftermath of the financial crisis, central banks flipped from being net sellers of gold to net buyers. That shift mattered more than people realize because it revealed that the institutions closest to the machinery of fiat were quietly diversifying away from over-reliance on paper claims. And now the buying has become relentless, year after year, country after country. Not fringe actors, serious reserve managers, Poland, China, India, Turkey, Kazakhstan, the Czech Republic, others all increasing gold reserves while reducing the relative comfort of holding dollar paper. That is not a superstition trade. That is not some online apocalypse cult. That is the institutional class saying, with action not words, that the world is becoming less comfortable holding promises and more interested in holding something that does not depend on promises. That is the fourth signal. And once all four signals line up, gold does what it has always done. It reprices brutally. Let me say that again, because this is the whole thing. First, debt becomes mathematically unpayable. Second, governments change the rules. Third, cash becomes a real loser. Fourth, central banks buy gold. That sequence is the setup. And each time the setup has appeared in full, gold has not merely drifted upward. It has exploded from $35 to $850, from roughly $250 to $1,900. from around $1,050 to near $4,800 in the current cycle. Framing, the numbers themselves matter less than the mechanism. If you only remember the numbers, you will treat gold like a chart. If you remember the mechanism, you will treat gold like a monetary response to state failure. That is a much more useful framework. Now, I want to be careful here because this is where people become stupid. They hear a thesis they like and they turn it into religion. They go all in. They treat a positioning idea like a personality trait. They stop thinking about risk. They stop respecting time. They stop respecting volatility. That is not how adults invest. Gold is not a get-rich-by-Friday trade. It is not a meme stock. It is not some magical line that only goes upward. In the 1970s, during one of the greatest gold bull markets in modern history, gold still suffered a brutal multi-year drawdown in the middle of the run. That is why risk management matters more than conviction. That is why position sizing matters more than enthusiasm. The right thesis can still ruin you if the position is sized like an emotional outburst. So I would never tell someone to put everything into gold. That is foolish. Gold does not produce income. It does not replace a full portfolio. It does not negate the need for businesses, productive assets, and real-world diversification. But I also think most people remain absurdly underexposed to it for the environment now unfolding. If the four signals are indeed flashing, and I believe they are, then treating gold as a trivial sideshow, while the very institutions running the monetary system are accumulating, it is a dangerous form of denial. That is why I think an asset. Class terms, not slogans. Stocks still matter, but which stocks matters, bonds still exist. But long-duration paper in a regime of repression and debasement should not be treated casually. Real estate can work, but financing conditions and local economics matter hugely. And metals, especially gold, serve a very specific role. They are not there to make you feel fashionable. They are there because when governments start solving debt problems by changing rules and punishing savers, the monetary metal becomes a defense against the state choosing devaluation over honesty. That is the role. And for some investors, there is another layer beyond bullion itself. Miners. Now, miners are a different animal, more risk, more operational complexity, more volatility, more company-specific failure points, but also more torque, because if it costs a miner $1,200 to pull an ounce out of the ground and the gold price goes up by a meaningful percentage, the margin expansion can be much larger than the percentage move in the metal itself. That is why miners can become extraordinary performers inside major gold bull phases. But again, that is not a beginner's game unless the position is appropriately sized and the investor understands the added business risk. The metal is the monetary core, the miners are the leveraged expression, and both should be understood through the same four-signal sequence, not through hype. Now, let me bring this all together in one plain statement. Gold does not explode because people suddenly get superstitious. It explodes because the state reaches the point where debt cannot be honored. Honestly, the rules start getting rewritten to preserve the debt structure. Savers begin getting systematically punished in real terms, and the institutions closest to the currency system begin quietly moving into gold before the crowd understands what is happening. That is the real pattern. And if you are waiting for permission from the media, from economists on television, from a neat consensus statement, or from the people who benefit most from the current system, you will get that permission only after the repricing is well underway. That is how it always works. The move begins while the old story still sounds more respectable. That is why so many people end up saying the same thing years later. I wish I had taken the debt more seriously. I wish I had understood the rule changes. I wish I had noticed my savings were melting. I wish I had paid attention when the central bank started buying. But the sequence does not reward wishing. It rewards seeing. If you want my plain Buffett version, it is this. Debt is the spark. Rule changes are the confession. Negative real returns are the public tax. Central bank gold buying is the institutional verdict. When all four line up, gold stops being an old relic and starts becoming a mirror held up to the monetary system, and the reflection is almost never flattering. That is what always happens before gold explodes. The question now is whether you want to notice the pattern while it is still a pattern, or only after it has become a price chart. Everybody suddenly pretends they understood all along.